We learned two things from the FOMC minutes today. Number one, at their May 2nd and 3rd meeting, this committee was on course, not committed, but on course for a June rate hike. Number two, there was wide agreement that they should not cease from 1 month to the next their reinvestments of assets on the balance sheet when they begin to reduce that balance sheet. So going back to the timing of the hike of the next rate hike, here's the key quote, I think, from today's minutes. Most participants judged that if economic information came in about in line with their expectations, it would soon be appropriate for the committee to take another step in removing some policy accommodation. So now remember, at the time of this meeting, the committee was dealing with a lot of weak GDP data from Q1 and some weak inflation data from March, and they made a lot of references to that data being transitory. That was underlined many times in the minutes. There was, however, a clear debate around the idea of inflation and where inflation was heading. Some in the committee are clearly more worried about the prospect of overshooting on inflation as unemployment continues to fall below the levels that they think are the lowest sustainable levels for unemployment, while others on the committee, another handful, are worried that some of the most recent data on inflation signals that there may be a pause in price rises there, and so perhaps the committee should be cautious about raising. Now, one big caveat to these minutes, they're a bit dated. The data that's come out since then is split. As you remember, the April payrolls data report was quite strong. That will support the hawks on the committee that want to see a hike in June. At the same time, however, April inflation CPI data was extremely weak, and so that will run the other way. And so I think it remains to be seen where that nets out on this committee. The one other important thing, again, as I mentioned, on the balance sheet plans, a lot of people in the market, especially in the bond market, are waiting for news on this. Here's the key bit from the minutes. The staff made a proposal, and they proposed this. The committee would announce a set of gradually increasing caps or limits on the dollar amounts of Treasury and agency securities that would be allowed to run off each month. The caps would initially be set at low levels and then be raised every 3 months over a set period of time to their fully phased-in levels. And here's the kicker. Nearly all policymakers expressed a favorable view of that general approach.